We're not live yet. Hi, everybody. Welcome back. Welcome back on VC TV, the Venture Capital TV from La Token. My name is Sunny Mohanty. I'm the Regional Director of La Token based here in Singapore, and I host VC TV. It's a platform to connect like-minded people. I have to say, like-minded people who can come together and share their ideas, share their knowledge, make connections, collaborate, scale, whatnot. So today again, I'm back here on another episode of VC TV to discuss about another important topic in the life cycle of a startup, of a business, right? How to exit out of a startup. So it's going to be, we're going to discuss from two perspectives, from a perspective of us of entrepreneur, the founder, and also investor, how to exit out of a startup. Okay, so it's very interesting. So let's have a quick round of introduction of the speakers of the panel today, and here we go. Hello, Vandana. Hi, Harsh, and hi, Keshav. Thanks for tuning in. So, how are you today? How is everybody doing?
Doing great.
Yeah, rocking.
Rocking. That's what we would like to know. Rocking. So great, Vandana. So let's start with some introduction because we have a very interesting topic, and hopefully everybody engages into a debate. We all love debate, don't we?
We love
debate, right? So let's just engage into a debate, sort of a conversation, discussion, to make it more fun and engaging. Let's start with the introductions of Keshav. Over to you, please.
Thanks, Vandana. Thanks, La Token TV, for having me over again. It's a pleasure being here. My name is Channa Keshav Adya. I go by Keshav. I'm based in Dubai. I've been in the industry for about 22 years. The first 10 years of which were fairly were with large corporates, Morgan Stanley, HSBC, Lloyds Banking Group, primarily working on technology, fintech, M&A, post-merger integration. The next 5 years were fairly entrepreneurial in nature. I've been a founder on 20 plus occasions, have had a number of exits. I've also buried a few companies. So I can completely empathize with the journey that founders follow, right from creating a concept and turning into a business and all the way to the exits through different routes. The last 5 years have been with Adan Corporate in the investment banking and corporate advisory space. I work on pretty much the whole spectrum of corporate finance and mergers and acquisitions, working with small, mid-sized businesses. We are a team of around 50 people in about 20 different countries, and we take on mandates in pretty much the whole spectrum of corporate finance. That's me. Thanks, Vandana. Thanks, Sunny. Sorry.
And no, it's okay. Vandana used to host you before. That's why you got confused. It's absolutely okay, Keshav. No issues there. Vandana, Sunny, it's all the same. We're all part of VC TV. Thank you, Keshav, for that intro, that rocking intro. Let's move to the rocking star next. Harsh.
Hey guys, glad to be back. Glad to have this amazing session here with the VC TV family as always, right? Just a quick intro about myself. I'm Harsh Shetia, venture partner with our ventures and the founder of Startup Hackers. We help early stage startups raise funds all the way from starting from 200 to 50K, all the way up to $15 million. Currently, we are working with mandates across the world, right? So I'm working on a Canadian mandate as well and a few other mandates as well. Additionally, our Facebook group of Startup Hackers, it's a very thriving group. We've almost reached close to 1,000 members just in the last 3-4 months alone, and we are growing quickly. And we are trying to create this ecosystem of startups where startups can help one another in terms of strategic partnerships, in terms of connections, and in terms of advice as well. So looking forward to a strong discussion today. Thank you so much.
Absolutely. Thank you, Harsh. Thank you so much for being here on a very important topic. Oh, I see Subhranshu. Hi. What a surprise. How are you? Long time.
Thank you, Sunny.
So where are you dialing in from today?
I'm from Singapore.
Okay, great.
I'm on quarantine. I just flew from San Francisco, landed yesterday, so I have to go through the process.
Oh my God! So you are basically in my position. What I was like, one month back, I was in quarantine as well in a hotel. Hope you are having a good time all alone by yourself. All me time. Great. Good to have you on this panel, Subhranshu. So can you have a quick round of intro about yourself, because you have Keshav who may not know you. So yeah.
Oh, thank you, Sony. I think it is very short notice. I've been with Frost and Sullivan from last 2 decades, and I'm currently in the board of directors of the headquarters, which we have in San Francisco, the Silicon Valley. And my role predominantly working with corporate disruptions which is happening, especially last 20 years, and the challenges which we face day-to-day life in many areas with existing business lines and new business lines are coming up. And we are identifying the solutions across the globe which can help these business lines to get optimized, and the new business lines could be created so that the corporate could be empowered. So my role predominantly from the board perspective, globally, we are working on identifying the white space of the corporations and trying to find the right solutions who can go and connect with them and start empowering each other. So that's the role, Sony, I have, and I look forward to discussing more in details.
Thank you so much, Subhranshu. So we're trying to I'm trying to figure out how to zoom in the person who is speaking as requested by Mr. Keshav. Thank you, Subhranshu, for that introduction. Really good to know about your strengths. So next I have Vandana. Hi, Vandana. Let's have a quick round of intro.
Yeah, hi, Sunny, and hi to all of you. It's nice to see Subhranshu, Keshav, and Harsh. And I want to thank firstly, I want to thank the Latokan team, Abhibek, Hasmik, and yourself for, making this Latokan platform, which is, a really good platform for everybody, because speakers come here from all over the world and share their insights, and there's a lot to gain from such platforms. So it's a very difficult task behind the scenes, which you guys do. So hats off to all of you. And coming to my intro, I had my family office in Singapore and Jakarta for 15 years. I was there in Singapore and Jakarta with my own family office there, where, this is my 7th year back in India. I did investments. Then I went back to advisory. So currently I'm connected with 300 investors globally, and we pick up global deals. I worked as an investment banker and advisor to many family offices and angel investors in Jakarta, Indonesia, helping startups from a diverse background, from Fin-Tech, B2B Tech, all the way to consumer startups. I was raising funds for them and providing them with a range of services, just as Convanto does today. And after 15 years of staying in Singapore and Jakarta, I came back to India. I did investments for a bit, and then I returned to advisory. That is when Convanto was founded. And today, Convanto is one of the most well-known boutique investment banks in India, led by a female founder. I'm also a venture advisor with Loyal VC, the INSEAD-led Canadian VC Fund, having a core portfolio of 160 investments in more than 35 countries. I'm also a partner with GST Venture Studios, a Silicon Valley-based venture builder. And over the years, I've arranged funding for startups and growth stage companies in diverse sectors like edutech, fintech, consumer, B2C and B2B, agri-tech, health tech, food tech, disruptive and deep tech, as well as non-tech sectors. I would recommend all of you to have a look at my website for the wonderful testimonials written by my clients. This month, I've been nominated as the top 10 women leaders in wealth management 2021. My expert opinion is sought by leading business news channels and publications like VCTV, Business World, and I've participated in 155 talks all over the world. You can easily see them on YouTube and VCTV streaming sites. We are typically sector agnostic, and our ticket size is $1 million to $25 million. And once again, thank you for having me here.
Oh, thank you, Vandana, so much for that intro. I was not sorry ignoring. I'm just trying to figure how to change the layout of this StreamYard. But anyways, I give up. So thank you so much for that intro. Great. We all set with the. There you go. Fixed. Thank you so much, Abul Beg. Thanks for listening to me. I was trying to actually get hold of him. So great. So we all set with introductions. Today we have Vandana, Harsh, Keshav, and Subhranshu. So the topic is about business preparing for a business for exit. When we say business over here, we're going to focus on a startup, right? So that's the whole idea. So before we jump into the deep dive into the details of this topic, what I just want to know what is a business exit? Why a startup should consider exiting out of a business, or if investor who's invested into the startup should consider exiting out of the business. Let's start with Keshav.
Sure. Typically, businesses go through exits in at least 4 or 5 different phases. If you are an entrepreneur, if you're the founder, you would have an exit. Typically when the company goes public, or when the company is acquired by another business. So that is, I would say, limited to a number of options, which can happen only if the company grows, right?
Mm-hmm.
Then, if the company is not doing very well, you might have to consider an exit by liquidating it and just closing down the business. So that is like the absolute worst case scenario, right?
Right.
And then there are a couple of other exit options where you're looking at secondary exits, or the sale of the business to a new co-founder, or an angel, or a fund, in lieu of money, or advisory services, or something of value, right? So that is another scenario where founders can look at an exit. Which is the best exit strategy? Well, it's obviously the one that makes you the most money and makes the others who are with you in that journey the most money. So it depends on the case. It depends on the scenario, and it varies on a case-by-case basis.
I think very good points. I'll just start to the topic. So next, I would like Harsh. Again, Harsh, obviously you are dealing with. I think you wrote about a virtual incubator as well. So you obviously see a wide range of startups. So can you also give an example? Like I'm going to come to Krishna as well with his portfolio. But what an exit strategy should be kept in mind, both for investor and startup, and examples?
Correct. So when we say an exit strategy, it's not particularly for a startup, but it's focused more towards the founders and the investors, right? Because the startup is going to be there. It is the people who are involved in the startup, like the founders, the investors, the core team members. We're talking about the exit for them, right? So that
Yeah.
is, that is essentially what we are referring to. Overall, every startup founder who's kind of building a startup, right? He needs to have a sound exit strategy in mind, which is suitable for his own industry, right? So, for example, in some industries, it would make more sense to go for the M&A route, where you get acquired by a much bigger rival. That would make the most sense rather than trying to kind of extend it too much. So for some companies that's the best option. For I'm hearing myself back. I have no idea what's the problem here. So for some other companies, IPO is a better route. So in some cases, what happens is you go, if your company becomes really big, like India is expecting 2 IPOs, like in the form of Zomato and Paytm, right? One of these are giant mammoth unicorn companies who are looking to get exit through an IPO. So essentially, there are multiple exit options which are required, and the reason why it is so important is because most of these companies, they have a VC funds who've invested in them, right? And every VC fund has a timeline of 11 to 12 years at best on the upper limit. On an average, it's 10 years, but it's extended by 1 or 2 years more, right? They need to provide exits to those kind of VC funds, where they can then provide returns to the LPs, which was there as a part of the VC fund, right? That's why the exit becomes very important for the investors as well. And also, many founders, sometimes what happens is founders sometimes they would want to continue with the startup as the CEO, or as the the still the controlling be a part of the organization. or in many cases, the founder would want to exit the business, like what happened with Flipkart. When the Bansals kind of exited the business altogether when Walmart acquired them, right? So the priorities are different, the routes are different, and as was pointed out earlier, it's extremely important finding out the right one which is suitable for your business, because only that way you can maximize true revenue potential. People might think that IPO is the best route, but that may or may not always be the case. So you need to be able to understand what the best opportunities are for your business.
So is it important to know about these exit options from day one when you're building your company or business?
So it's not about knowing, because the thing is, it is so dynamic, right? What happens is even the legalities of it are changing on a frequent basis, right? Sometimes what happens is, just for example, just 3-4 years back, doing an IPO for a loss-making company in India was
Hmm.
unheard of. It wasn't even allowed. The government would not allow a net negative company to be listed on the platform. And now they've created another opportunity where even if you are negative, but if you're creating a significant amount of value and if you're at that level of scale, you can still do an IPO. But it is
Right.
not that popular in India compared to, say, a Singapore or a Hong Kong or a Nasdaq or any of that sorts, right? So there are a lot of it's there are multiple factors at play. At the same time, IPO would make sense when you want to truly, give an exit to the retail investor route, right? But you can even go through the private equity investor route or through an M&A route. So, for example, clean tech, green tech right now, it's an extremely booming area, right? Over there, it would make more sense to go through an M&A acquisition through a private equity or to another larger player in the place, because there you will get much better exits other than doing an IPO, because most of these clean tech companies, they are still not what we call finished technology. They're still at a very early stage development, right? So at the product stage, you can still get acquired by a larger company or by a larger private equity player. So it's very industry specific, very customized, and that's why the founders need to have at least some semblance of approach in mind, that this is what essentially what we are looking at.
Absolutely.
Obviously, it'll change depending on the time, but at least some idea.
Yeah. 10 years, right?
10 years for a VC fund, for a startup, it could be anything. It'll completely depend on how quick you're growing up, right?
Right. Okay, great. Thank you, Harsh, for sharing those insights. Let's hear from Subhranshu about his thoughts about exit strategy, because obviously Subhranshu deals with startups and mentors them, consults them. So I think it's very important to know what his views are. Over to you.
There are three areas. It's not a knowledge we are sharing. This is the reality.
Right.
Investors, founders, and other shareholders. All three parties create that business, and every individual have their own way of thinking their exit. When we all think about the exit, the two things comes. One's the risk, other is the return. When the risk increases, then we are in a panic situation to let go. When return increases, that of course we have to stay there, right? So exit strategy primarily dependent on risk adjusted return. If investors is looking at risk adjusted return, they have their own mathematics around this. They may push founders to exit. Founders have a limited choice as well sometimes, and most of the times. Other shareholders, which are the ecosystems providers, they are equally having similar mindsets. When they feel that risk is increasing and adjusted return is not coming up, they will also let it go. So it's not the easy task to understand how to exit, who is exiting. The decision is taken by the investors or founders or by other shareholders. But if it is founder's decision to take exit, yes, I think already we have discussed around those lines. If I'm an investor, I will have my own way of thinking where and how I can continue my exit depending on when the suitable time, when my risk is more and return is less, right? So that's where I know we will go more further discussion on those areas, but these are the definition and nomenclature how to look at risk and return for the exit.
Absolutely. Risk and return for the exit. Thank you so much, Subhranshu, for sharing those opening remarks. Let's next move to our speaker, Vandana. Vandana, over to you, please.
Yeah, thank you, Sunny. So, the first step is should be to prepare your finances. The first step is to develop an exit plan, to prepare an accurate account of your finances, both personally and professionally. The business should consider their options, and once you have a complete picture of your finances, consider several exit strategies to determine your best option. And then, speak with your investors, approach your investors and stakeholders to share your intent to exit the business, create a strategy that advises the investors on how they will be repaid, and then choose a new leadership. Once you have decided to exit your business, start transferring some of your responsibilities to new leadership while you finalize your plan. Then tell your employees, when your succession plans are in place, share the news with your employees and be prepared to answer their questions. Then inform your customers that finally, tell your clients and customers if your business will continue with new owners, introduce them to your clients. And if you are closing your business for good, give your customers, alternative options. I think this is very important. And also, the first option is to give exit to the investor through an IPO in approximately 5 years. Getting the company shares listed on stock exchange so that with the liquidity coming through trading of shares, the investor can sell his shares anytime, partially or fully. And if the IPO is not possible, then the company should appoint an independent valuer of the shares and find a third party investor who will buy the shares from the original investor. The new investor should buy the shares at a price which will give the required IRR, that is internal rate of return, to the original investor. The IRR asked is usually 20 to 25%. Now, if the second option is not possible, then the company should buy back the shares from the original investor by giving him the required IRR. If the third option is not possible, then the founder should buy back the equity from the original founder by giving him the required IRR. And if all of the above doesn't happen, then the company should look for a strategic partner, one who buys a big stake in the business as a strategic investor and not as a financial investor, hence gives the exit to the original investor. So this is my small take. Of course, all the panelists have covered pretty much all the things.
Okay, I think Vandana, you've covered the entire lifestyle cycle and what if this, then this, and what if this. That's a great information that you've shared. But I just want to a little bit touch base on a few things that you just mentioned. So so what's the best strategy? I mean, just generally speaking, is it an M&A, merger and acquisition, or raising capital for the rounds? What you've seen so far? Sorry, what you've seen so far, and what's the best way to go forward with this? Sorry, Keshav, sorry about that.
Well, it is entirely dependent on what the motivation is. We've seen M&A yield returns, and then there are funding rounds which can yield returns at more or less the same set of comparable multiples. However, what matters is the timeline of the exit. So with M&A, for example, if there is a business acquisition, you're looking at a set of KPIs being met over the next 18 months to 2 years time, post which the investors, or should I say in this case the founders, can look at a complete exit. With funding rounds, however, the founders will have to stay back till such point there is an exit, a complete exit for them, right? So it again depends on a case by case basis. It all depends on the motivations of the people here. One underrated strategy is that founders do not think through when they start a business is the tax strategy, because there are certain jurisdictions where where you can essentially maximize your net income, and you can reduce your tax burden. Places such as Singapore, for example, or the UK, they have especially in Singapore, you can avoid paying any capital gains tax from the sale of the equity. But in places like India and a couple of other jurisdictions, you're taxed. So you'll also have to factor in all of this. There are obviously a few more points which I want to cover, but we'll discuss that.
That's a very good point. So do you think because of this, Singapore is seen as a more friendlier jurisdictions for startups to?
Well, in my experience, and even I did this, I set up the business in India, for example, and post the first angel round, we set up a business in Singapore so that the investors were covered from a tax perspective. Similarly, we eventually moved to the UK. But yes, that's something which not a lot of founders think through when they establish a business. And then you have all these different tax rules in different jurisdictions that also comes to back. So you'll have to go back and reaccount everything depending on where you're raising capital or where the investors are from. So
that's a very good point. So startups, you have to consider where you were actually, once you've got that early seed money, when you're growing or whatever, you're planning the long term, then think about the jurisdictions you're going to be incorporated because of a tax just benefits that some countries provide, like Singapore, as opposed to maybe India. Just giving an example.
and it's also about how you set up the holding company, how you set up the operating company. So there are ways around that as well. So it's just a matter of, I suppose, having someone knowledgeable, either in the form of an advisor or an investor,
Right.
comes in with this specialized knowledge who can help with the exit. Because at the end of the day, if you look at it, when you set up a business, especially the ones that we have going on in the tech space, you always have to build with an exit in mind. An exit not just for yourself, but also for the other investors, because they can't stay invested forever, right? And as Harsh mentioned, all funds have some sort of a shelf life, and they will look at an exit in the next 3 to 5 years, depending on where they are in that life cycle. So you definitely need a strategy, because hope is not a strategy. So you need to have some sort of a business plan solely focused on the exit in mind, and then depending on that exit and the most suitable outcome, you can sort of drive the business towards those KPIs and towards that exit strategy.
Great point, Keshav. I thoroughly agree. I mean, you have to do it from day one. You have to plan your exit strategy from day one. Harsh, coming to you, I mean, obviously, Keshav has covered very good points with tax in mind as well. So we're talking about M&A versus further capital raising. So if what have you seen so far, and why do you think some? Obviously, it's depending what the founders and investors have thought through, a case by case basis, as Keshav said. But what generally you've seen?
So generally, what I have seen is, as Keshav was kind of pointing out, right? This is unfortunately not a very glamorous version of building a startup, right? So most of the founders kind of ignore this. But I kind of say that fundraising is a dedicated job where you need one dedicated co-founder actively focusing on just fundraising, the investor relations, looking at strategic aspect of the business, right? You need one dedicated person just to focus on this. So if you're at a pre-series A, series A level or beyond, what typically tends to happen is you'll get a lot of exit options as well. But most founders, they simply focus on working on the business. They work as grinders, and they don't understand what kind of other opportunities are there for them, right? Even when they look at fundraising, they're simply focusing at equity fundraising and diluting themselves into oblivion when they have other debt options as well. There are other revenue-based financing options as well, but then they've never thought through of those kind of options, right? There are some options where you can get a funding, where you can get some royalty payouts from the beginning itself, which will secure the investors upfront capital that they've deployed, until give them small equity interest in the company and won't dilute themselves too much. But the founders don't think through those multiple myriad of options which are there. So that is why I believe startup founders need to be much more active. And this is, I'm not talking about just the young founders, the 22, 24-year-old engineering grads. I'm talking about mature startup founders, significant corporate experience. Even they tend to kind of miss the step in these kind of elements. So that's why what happens is sometimes, because the way the startup game is structured, what tends to happen is you'll tend to make a lot of losses at some point of time, right? Because of that, what happens is, if you don't get the funding at the right point of time, So I have a sales and marketing background, right? So there's always a phrase, right? Always be closing. So likewise, in startup fundraising, it's the always be fundraising. It's an ongoing process, right? And if there is any investor, any VC who's willing to write the check to you, just take it at that point of time. Even if you don't need it, take it at that point of time, because it will give you that extra 6 months, 9 months, 1 year runway, which you would have otherwise, you would have, if you are actively focusing on fundraising, any VC, it will take at least 6 to 9 months to raise funds. Any equity investor, doesn't matter who it is, right? So that's why if they're giving it to you upfront, just take it, because it gives you that kind of a push, to kind of take it forward. So that's why, I think the startup founders, they've never really thought through the exit options, the fundraising options, and they need to be more open minded regarding what kind of options that they have. Keshav very eloquently mentioned the tax options as well, right? That is
Yeah.
extremely important. In fact, there are countries like Georgia, etc., where the tax systems are far more beneficial than even Singapore. The taxes are extremely low, LTCGs are extremely low. However, the country is not that developed, so people would not kind of trust them. But there are lots of creative options which are there, and you need to kind of creatively figure out which one suits your interest the best.
Yeah, definitely not Georgia for sure. Sorry.
Tax
So
wise, it's the best, but trust wise, it becomes a bit of an issue.
yeah, I mean, you're just not incorporating a company. You obviously would probably hire and have office and all that stuff. Trust is another factor, as you rightly said as well. So thank you so much, Harsh. Coming over to Subhanshu, what's your thoughts? I mean, obviously everybody have just said that it's a case by case basis, depending on how the investors and the founders are thinking through this. But what have you seen, like in your with your experience? Is it an M&A or a further capital raise? So Subhanshu, over to you. Spotlight.
Yeah, I think already talked about investors. I think all of you have worked as a VC industry. You understand that there is a shelf life of fund. So investors have very few uh, strategies around that, because their LPs are driven by these guidelines. You cannot raise funds without having an exit strategy. So investors are very clean. 10 years fund, 7 years exit, blah blah. If you're coming to founders exit strategy is dependent on how the business is moving and what sort of vision these guys have. There are three areas of founding members you'll find. A lot of copycat model you will see. Grab, we talk about Uber. So people have copied this same model and try to implement this in the other countries, and they know the best way to do this. As they keep on growing their customer base, they will find a way to move. And some of the pure innovations, you saw Google, you saw Facebook, pure innovations. So they know how to build it, and they have a vision for hold it for some time. Third areas are more of demand and supply side, where you match the demand and supply side, do an M&A and leave. So it is all the ability of that intuitiveness, where they find where they fit into the bucket, how and where they need to exit, and what is that objectively they want to get it.
Right.
And the third part is the other stakeholders, are the minority stakeholders. They have hardly any say in this business. So founder and investors will take that call. So as you all have said, exit has their own way of thinking. Every individual is thinking in a very different way and a very dynamically approached. But those founders, those who have an exit strategy in the day one,
Yeah.
this is very theoretical. This is very, very theoretical. Okay.
Right.
We have seen bunch of these guys, they can talk today, and after 3 years, things changed. Either they go out of the market or they change their exit strategy, because ecosystem changes is very, very dynamic. It is not written in the books to when the exit strategy will happen. However, it is most importantly, the new generation startup communities need to have some level of exit strategy that makes them more clear vision. That make them sure that if there is an issues, they can get their market valuation up, go and do an M&A, or go find the demand sites and exit.
I think that's the point to consider. Thank you, Subhanshu. You can plan things, but things change. It's very dynamic. Probably in 3 years, you are not going to stick to what you planned in day one when you're setting up your business. So yeah, I think that's a very good point to consider for founders and entrepreneurs and investors on the panel today. Vandana, over to you with your insights, please.
So actually, it depends from case to case. It depends from investor to investor. There are a lot of factors, so there can't be any one particular. But my favorite is M&A because it's a very good option of exiting a business is to merge or get acquired by another company. And mergers of companies with complementary capabilities bring economies of scale to the newly formed business. And look for a capitalized acquirer who can actually close deals fast on a professional terms. And in an acquisition, the entrepreneur's equity will be taken over by the acquirer, thereby providing him with an exit. And also, one should vary of running your company with the aim of being acquired by one specific company. And if you are a planned acquirer, is not interested, you're risk building a product so specialized that no other businesses will buy you either. So I think this is one of my favorites, but of course it depends from case to case.
Sure, thank you so much. Because obviously, as an investment banker, you've seen so many deals, and obviously you've seen where you've dealt more with M&A as opposed to the other side. But yeah, that's absolutely fine. It's case by case basis. Okay, coming to exit, if there is an exit strategy in place, what are the steps needed to consider not to ruin that exit? So, okay, fine, we have made our minds, we're going to exit out of this business. So how not to ruin your first exit, if it's a first exit? Harsh?
So I'm not sure what first exit you're referring to, but typically what happens is, when anytime you have like a major exit event, right? More often than not, it is, in the form of an acquisition or an IPO, right? So I think in the last couple years, we saw this example, right? Especially for Uber. Everyone was thinking Uber is going to be this big bang IPO, ridiculous valuation and all that stuff. But it kind of turned, and the best part, it was a B2C business, right? So that's why it was, everyone thought it was perfect for an IPO and for retail investors to get them on board, right? B2B business IPO may not make that much sense, but for a B2C business, it makes absolute sense. And we saw the results for Uber; it did not go out that well. So that is why it's extremely important to go through the mindset as well. In IPO, the investment strategy is completely different than in private investing, right? So you need to understand, Uber was a loss-making company, and the CEO has kind of outrightly mentioned that there are some companies which won't make profits in for a very long period, right? And if you are doing an IPO, listing yourself on a stock exchange, and you tell that your company is not going to make profit, it doesn't make sense to go for an IPO anyways. You would be served better than to do like a private equity. So that's why identifying the right strategy becomes extremely crucial. Even WeWork was planning their own IPO, and they completely pulled out of that as well, right? Because WeWork was valued at such ridiculously high valuations which made no sense, and the companies has been struggling since then. Even right now, the valuations are very low, and so that's why it becomes extremely critical that too much VC funding. That's why most founders think that getting these high VC funding and high valuation is a good thing for them, but that's actually not, because there are some clauses which are included in the term sheets and the SHAs, where if they don't get the right exit, these clauses will kick in, and even if there's some money which is coming in, the founders won't get anything. Most money will go to cover the initial upfront investment which has been done by the VCs. It'll go towards that rather than anything coming in the founders' way. So that's why these exit plans needs to be very carefully thought out.
Very good. I think it's a very good point. Thank you so much, Harsh. Next, I have who I have missed out. Okay, I think Subhranshu is still here. Subhranshu, yeah, since you are going to be dropping off soon for a meeting, let's take it from you.
Yeah, I think this is all about knowing your own product and services is very important. If you know your customer base, you know B2C, B2B, again, it is a very blanket statement. B2C becoming B2B, B2B becoming B2B and B2C, right? So, knowing your product is very important. As a founder, if I know my product, if I know there is a demand side is waiting for me, it's much easier to look at M&A strategies. And M&A strategies builds 5 years planning, identifying the right set of demand side, making sure that you can get your pitch done correctly, keep on finding this, and you find one day and you make them as your investors. And if you are in a journey of innovation, real innovation, absolute innovation, you know your intuitiveness works there, you know, to hold it. You want to get it to a scale where you can identify yourself and create a distinctive value propositions, your innovative. In this part of the world, hardly this company happens, right? You will find most of these areas you will find from Europe and US because they can hold it, and it's a real innovations. It's not a copycat model. In this part of the world, you find a lot of copycat model. You copy it, build it, make a lot of tons of money. Nothing wrong in that. So, founder's perspective, knowing your product, identifying your demand side, whether you're a copycat model or innovation model, that makes a lot of sense. Unless you understand that, you are just running behind something. You can continue to make money, as Harsh said. You can also may not make money as well. So you set it off, you exit, you don't make money. So these are all areas where a founder who has a lot of understanding, they can probably get into a stage, exit, and make a lot of money.
That's a great point as well. Thank you so much for sharing, Subhranshu.
So thank you so much, guys. I have to leave. I would apologize for the last minute getting into the call and also leaving early. And I'll see you guys soon. Thank you.
Thank you so much for your participation today. I appreciate this was last minute, but still you made it to the show. Thank you so much and have a great day.
Thank you, guys. Take care.
Okay, great. So Subhranshu had great points to share as well. You can make a lot of money, so plan your exit properly, entrepreneurs. Next, coming over to Keshav.
Okay, from personal experience, from a few exits as a co-founder as well as an investor, there are a couple of places where both investments as well as acquisitions fail. Number one, the due diligence phase. The due diligence is the most critical part of the entire deal, where you have to prove essentially everything that you've written in your pitch deck, right from your sales figures to your your projected account numbers to of course the other financial statements, to the team, to what the grand vision is and everything else, right? So if you are a founder, you have to prepare for the due diligence phase. Okay, there are certain processes that you need to follow. There are certain documents that you need to collect beforehand. There are certain valuation methods that you need to be prepared for during the commercial negotiation phase. It's called the football field analysis, where you use different valuation techniques, for example, to defend the valuation of your business during the due diligence phase. Because as an investor, I would look at finding the gaps and finding risks with your business before investing. So as a founder, you need to have the right set of risk mitigation strategies and answers to those questions in the due diligence phase, right? So that's the first key to a successful acquisition or an investment. The second is the actual commercial negotiation phase, where you'll find that a lot of negotiations fail because the investors have a different perceived value of the business, and the founders seem to have an over optimistic or valuation of their business, sometimes looking at ridiculous or astronomical valuation. So from the perspective of financial modeling and the financial valuation, you need to have someone experienced assisting you with this exercise, because at the end of the day, that is literally the last mile for the exit, right? Once the valuation is decided, once the investing strategy is decided, once the legalities are confirmed, you are looking at an exit in a few months time, right? Then of course, at the very outset, you need to have a proper investor outreach strategy. Now, this is going back all the way, even before you get started. So things such as, what the market sentiment is, looking at other exits, looking at other other businesses, who are and what their exit multiples are. So if the market is in a downturn, for example, last year the retail, travel, tourism markets were not doing so well. So that was the worst time to exit the business, right? But you will see market cycles. So at what point in the cycle you are, is something you'll have to decide up front, before even looking at an exit. And then, based on the market sentiments, you look at the right set of investors, either strategic investors or financial investors, what the ticket sizes are, what their investment philosophy is, what sort of investments they've done in the past. If they funded a competitor, then they're never going to fund you. So things such as these. And then, what works really well is word of mouth, as in your investors referring you to the next set of investors, or your clients referring you to investors, etc. So those warm intros, definitely help with a faster exit. And then there are other things such as, creating a good brand before the exit. That helps. If it's pleasing to the eye, if it says if it is what it says on the tin, then you're looking at a much better valuation. And if you've got a succession plan, because you're looking to get out of the business, that adds more brownie points to the overall exit strategy. So it's always advisable to have someone experienced in this journey. And like Harsh mentioned, it is a full-time job. Fundraising is a full-time job. For that matter, even scouting an exit, either in the form of an M&A or investment, is a full-time job. So you need to have someone really experienced to assist with this entire exercise.
Great points again. It's a full-time job, honestly. Absolutely, totally agree with that viewpoint. But thanks for sharing your insights as well. Okay, I think Sprangshu is gone. So Vandana, so let's just hear it from you. Like, when's the right time to exit? Obviously there is no right time, as we all realized through this session that there is no right time. But how not to fail it? Like, how to not ruin it, if at all there is an exit strategy in place?
So actually, there are lots of factors. In my view, there are lots of mistakes that business owners typically make when trying to sell their business. Now, first is, failing to plan in advance. A recent survey conducted by PwC found that mere of 25% of business owners had done any formal planning or selling or transitioning their business. By preparing an exit strategy in advance, you have the opportunity to sell at your terms when you want to and not when you have to. And taking a proactive approach to the sale of your business in most cases will allow you to do so. Then pay less tax on the proceeds. A number of tax planning opportunities are available to maximize the amount of cash that you and your family members can retain on a transaction. But most of these strategies must be implemented years in advance in order to be effective. And the structure of the transaction will also likely have a significant impact on your after-tax proceeds. And it is important to be aware of these implications in advance of negotiations with potential purchasers. Then also enhance the value of your business. It is critical that you understand the motives and objectives of the potential purchasers. Value enhancement strategies can then be implemented to make the business more attractive to them. But again, these strategies take time to implement, and these can include upgrading information technology, removing assets that are more valuable if you sold separately, like a non-core operating division, real estate investment, etc., and locking in the key employees via non-compete agreements. So there are lots of things actually, but if If you tell me to speak, I'll just go on and on. So
No, it's okay. It's okay. We can break this session because this seems to be a very popular. Like some of the sessions, some of the topics are
yeah,
obviously more popular in the sense we have a lot of talking points and we want to extend. So we can have
yeah,
this session continue in another day.
yeah,
I mean, this topic another day for sure, because this is a 1 hour show. We try to 50 minutes show. We try to be within time. So yeah, thank you so much, Vandana, for sharing your
thank
insights,
you.
Harsh and Keshav. So I think exiting out of a business, it's a very important aspect of any business, right? I mean, you have
Mhm.
the investors, you have the entrepreneurs, you have the founders, you have other members of the ecosystem as well, as Subhranshu rightly said. So it's a very crucial point for any business to strategize the exit, and there are different ways of exiting out of a business, as we all know, M&A or sort of. Or maybe growing your business, scaling it up and being a part of the business itself, exiting. So that's another way as well. So good to know about all these perspectives. It's a very educational session for all the startups and founders who are thinking what to do next. It's something like it's a very dynamic space. It's not like you plan something and execute after 3 months. It's a very dynamic space and things are changing, ever changing. So thanks for your sharing your insights. On that note, I would like to take some closing thoughts about this topic before we wrap up the show. Let's start with you, Keshav.
Sure, thanks. So just a couple of things with regards to exits. There are a few things such as um, planning for the exit, also estimating the cost of the exit, because fundraising or M&A will include investment bankers, and you have to include some sort of a budget for them as well
Yeah.
in the overall plan. And then the timing, because these deals can take anywhere between 6 months to 18 months to close, depending on the length of the due diligence exercise, right? So these three factors, I would say, would make or break the exit. And if you'd like to, talk about your business, I can be reached at ck.adya@ancorporate.com. You can follow me on Twitter at ckadya, CKADYA, that is. And yeah, looking forward. Sunny.
Thank you, Keshav. Thanks for the closing remarks. And yes, you can always reach out to Keshav on that LinkedIn, his LinkedIn handle as well, and on BCTV. So he's available on BCTV. He's a regular speaker. So please, thank you so much, Keshav, for that. Next, I have Harsh.
Yeah. Hi. Thank you so much. So Kesha was quite kind of right to point out, these kind of services have their fees associated with that, right? A lot of the times the founders are not familiar and not aware of, the kind of work which is involved over there, the complexity of the work which is involved over here, and it's kind of taken for granted. But the importance of this cannot be understated. And if these things are not done properly and not done with the right advisor, kind of running them through, this could make or break your business, right? So they need to understand the gravity of how important this is, because it's not just about building a business, growing the sales channels, optimizing the production, right? This is a very crucial part of running a startup, and that's why you need to kind of have the right advisors and mentors in place, the right bankers in place who can kind of guide you through these kind of process. Because without that, it's going to be extremely difficult to kind of get the right exit, right? So that's why founders need to kind of keep an open mind and understand the gravity of the situation, because it's if this thing is not done properly, it could become very detrimental for them, for the company in the longer run, and in the end, no one will get the returns which they're expecting for. So a small price to pay for a much larger gain. So that is what I would advise the startups to look at. And if any startup wants to have a casual discussion with me, with the fundraise or even the business strategy as a whole, would be happy to help out. I'm available on LinkedIn at Harsh Shetia, and looking forward to a lot of discussions. Thank you so much.
Thank you so much. And Harsh can always be found on BCTV. He's a regular speaker on BCTV as well, as a core family member, joined by Keshav now. So, yes, thank you so much, Keshav and Harsh. Last but not least, Vandana.
So thank you, Sunny. Like all the panelists have pretty much covered everything, but I just want to highlight a few things. An exit plan may be used to close down a non-profitable business, execute an investment or a business venture when profit objectives are met, to close down a business in the event of a significant change in the market conditions, sell an investment or a company, and sell an unsuccessful company to limit losses, reduce ownership in a company, or give up control. And if anybody wants to know more about this, please feel free to reach out to me via LinkedIn or my website, www.convanto.com. And once again, thank you to VCTV family. I mean, it's a place for like-minded people. It's my family time always. So thank you, Sunny, for having me here.
So thank you so much, Vandana, Harsh, and Keshav, and Subhranshu for your insights today. And for the viewers of VCTV, please catch me on another episode of VCTV soon. And I'd like to thank Vandana again, Keshav, and Harsh for your insights today. And I'll be back again on another episode. Till then, keep watching VCTV and showing your support to VCTV. And take care of yourselves. And take care of yourself, Vandana, Harsh, and Keshav. And see you